My name's Areiel Wonalow. I'm the managing director of FinServ Experts, which is a company I started after leaving IBM in 2016, when I realized that IBM's clients, as well as many other large enterprises, were throwing millions and millions and millions of dollars into emerging technology projects, blockchain, AI, robotics, quantum, what have you. And these clients were implementing these technologies, using them to basically re-implement the business models they already had, and were surprised that those investments never really delivered much in the way of value. So when I started FinServ Experts, I said, we're going to start with the business model. We are a technology firm, but what we're really doing is implementing business models that wouldn't be possible without emerging technologies. And we would focus on actually getting the value out of these new technologies. So short plug on myself. Got an awesome panel of investment experts. And I would like to start with Lorena, who we met on the last panel. Douglas is not able to join us due to, you guessed it, COVID. So Lorena has agreed to stay on from the last panel and continue gracing us with her expertise. Thank you. I want to talk about, since this is a global expansion conference, how innovators get access to the things they need. Money, yes, but advice, business expertise, technology expertise. Typically, some of the best sources for these things are national in scope. Here in the UK, like Innovate UK, most governments have, whether it's through a desire to just boost their industrial competitiveness or through more targeted industrial policy, ways of helping countries in that country succeed. But a lot of the things we're talking about are solutions that only make sense when they are handled with a global scope. So my question for you, Lorena, is what advice can you give to innovators, to investors who are looking for access to advice, to money, to expertise for global solutions which may not be covered by the scope of Innovate UK or the scope of any other nationally focused source of expertise? Where can companies with global solutions go?
Well, thank you for the question. I think that nowadays it's all global. So finally, you can, when you map all the ecosystem regarding to these issues, you can find how different kind of government are being able to help you. Could be here in UK, a lot of institutions, a lot of investment on these kind of things. But you can find as well what is happening in the United States. And nowadays, even the teams from one company are global. So I think that it's a bit strange to find some teams nowadays working on innovation and tech companies who belong to the same country. So nowadays, for example, in my experience just regarding to NFTs and blockchain and all these kind of things, where we were running in a team running globally. It's all global nowadays. So you can access, for example, to, in one company who has been working with, they access to money from the state money from different areas, from India, from Pakistan, from United States, from UK. Amazing, but this is the nowadays how the business have been going ahead. So I think that when you think about how to go in there, if the team is global, it's because the challenge is global and the necessities of this kind of product or service is global, and the money is global as well.
Any other
in my experience.
Any other thoughts?
I think access to content, knowledge, and expertise these days is absolutely available, especially because of the digital space that we're living in. And so like yesterday, I reached out to an NFT founder because one of our the investment committee members, they decided to actually explore the space of NFT. And we have never explored that space. And it was just a matter of just opening up LinkedIn and just reaching out to 4 or 5 people from the investment background, from the arts background, from the conventional arts background, and creating a collective pool of knowledge and information, and then making your decision on that. So I think we're living in very fortunate times that content and knowledge is easily and readily available.
Cool, thanks. Mike, I'm going to take advantage of the fact that we're on a stage together and ask you a follow-up question to your keynote. You talked, I think you did a great job of framing the empirical evidence about climate change and why it needs action, as well as understanding that it can be a very lucrative and successful, scalable business as well. And yet, despite the fact that I think there's a shared understanding that it's important and that you can have a successful business model, I think it would be fair to classify the level of investment we've been seeing in carbon as timid compared to what's needed and compared to the value that can be realized. So the short question is then is why? Are carbon markets the right answer? Is just fear of greenwashing? What's driving the timidity, and how do we get past it?
So a couple of things. I speak a lot about climate change in the investment management industry, so this is quite unusual for me to be speaking at a conference like this. What I find is the following. Whether it's BlackRock or the other big, large asset managers, on the stage, there is usually very much talk that environmental, social, and governance issues are front and center and the core focus. Often off the stage in a one-on-one environment, it's quite the reverse. The focus is really on traditional investment management concerns and risk management, which of course those are the dominant concerns when you're a professional investment management organization. But there's a real dislocation between talk and action. So I completely endorse that. When you come to the solutions on climate change, and as I alluded to, studying what has been tried, and most things have failed to bend the emissions curve downwards, but pricing carbon has been effective in this regard. I gave the information on what's happening in the regulated markets. What I did not talk about was the unregulated carbon markets. And people are often confused with carbon between the regulated markets and the voluntary. So I think it would be very useful for me to cover that, because I currently have quite serious concerns about what's happening in the voluntary carbon market. So most of us who understand carbon, maybe when you book a flight, you get an option to click on something to offset your flight. Normally that's a voluntary carbon credit or carbon offset. In the market in which we invest, that's a carbon allowance permit. The 5 key differences between these markets are as follows. The voluntary market is based on a project. We plant trees. As the trees grow, they sequester and store carbon dioxide. That's very good. Of course, trees have a natural lifespan. They then die, and when they die and decompose, they release the carbon dioxide back into the atmosphere. Many people are not aware that a mature forest is in equilibrium. It has already stored a great deal of carbon, but on a year-by-year basis, it's not sequestering a huge additional amount of carbon. So the voluntary market is around these projects, mangrove swamps, but mainly forestry and other nature-based solutions. The market is, first of all, it's unregulated, and that's a concern. It's illiquid. It's a private equity investment. It's small in size, and it's very opaque. So it's very difficult to find out how did they calculate how much carbon was actually stored in this credit. And number 5, it's effectively an unlimited supply. That's concerning. In the regulated markets, it's highly regulated. It's very liquid. We're trading $3 to $5 billion a day. It's very large in size. That size difference, to put that in perspective, between these 2 carbon markets is about 1,000 times difference in size. This is not 10 times. It's a huge difference. Very transparent. The government publishes all the rules, of course. And the final point, in the regulated market, the supply of carbon permits is capped. And every year the supply goes down. In the voluntary market, we have unlimited supply. And my concern is, because we manage the World Carbon Fund, in my inbox, I receive many, many proposals now for a new carbon project, low carbon. And the two words that I think are the most important in this regard are moral hazard. The unregulated nature of that voluntary market means moral hazard and conflict of interest are at the maximum level. And therefore, from a perspective of an investor or an institution who does not want headline risk, you don't want to buy a carbon project to offset your emissions and then find out 6 months later all of the trees burned down or were blown down in a storm, or in some cases were never even planted. So very important to understand, distinguish between these two markets. I think for climate change we need the voluntary market. I think it needs much more regulation, much more veracity and robustness around it, and I'm hoping we're going to get there. I fear the way we get there is first through large financial losses, because now it's becoming a frenzy. After that, I think regulation will come in, and then my hope is to see the market scale.
Thanks. So Jonathan, coming to you next. I want to segue that. A lot of the newest innovations, newest investment spaces are around areas of unlimited supply, or to the extent that there are limits, those limits are artificially imposed. Crypto, NFTs, metaverse, IP in general, these are all limited. I want to go back and talk about the oldest investment opportunity and the one with the most limited supply, which is land. How are all of these emerging technologies changing the way in which investment and operation of real estate is happening?
It's a very short question with an enormously long answer, which I'll try and bring down. First of all, I'd like to say I completely agree with what you said, and I would further add that carbon markets, in terms of addressing climate change, are a scratch on the butt of a flea on the back of a pack of dogs. It is tiny in terms of what it's going to do. The reality is that in 2020, 34 gigatons of carbon were emitted. Last year, it was even more, despite the pandemic and everything else. And that continues. We haven't even stopped the rise yet, let alone address the reduction. So real estate is an important part. Real estate represents 40% of carbon emissions. If you look at the construction and the operation of real estate, it's an enormous issue. And despite huge investment in PropTech in general over the last several years, there is relatively little progress being made. And that comes from because of a number of reasons. The first is that real estate, and just to give you a little bit of background, I spent 20 years in strategy consulting for people like IBM and so on, my own consultancy, around how emerging technologies would drive businesses and so on. I've spent 15 years in the environmental space, a bit of overlap in all of that. And today I happen to be here as founder of AirSensor, which is one of the companies that I have at the moment. But all of those things really are focused around data acquisition and understanding what's going on. So in all of that experience, real estate is an enormously tech laggard industry. It is.
Why is that?
It just hasn't had to be at the forefront of tech. People don't do things generally in business, and I'm being very broad brush here, apologies to anybody who isn't like this, but they don't tend to do these until they're forced to do so. So that's why regulation is important. That's why rules are important, compliance and so on and so forth. And in the real estate industry, they haven't had to. It's been buoyant for a very long time. As they say, God ain't making any more land, so it's a finite resource. So they haven't had to do any of that stuff. And what you see now is this confluence of post-COVID environment, a huge uptick in the requirement around ESG reporting and climate impact and so on. And the result of that is pressure on real estate in terms of occupancy levels, pressure on people to be reporting to ESG and climate and so on and so forth. What's actually happening so far is relatively small. You've seen PropTech investments, the majority of them that are making progress are in things like Zoopla, or finding tenancy stuff for commercial real estate, or tenant apps to help people, sort of book rooms in tenants and stuff. In the actual real estate ownership level, it is quite disturbing what's going on in terms of things like carbon reporting, because what you're seeing in the big REITs and the big owners, they tend to be trying to do offsetting, which is like buying indulgences from the Catholic Church, right? it doesn't get you anywhere with climate change. So if you honestly look this up, some of the biggest real estate owners have now started buying huge swathes of highland land, or bits of Australia and so on, or Brazil and so on, and they're going to be planting things or whatever it happens to be, which is it's awful. It's really not going to make any difference. What they have to be focusing on, if they're really going to get to where they need to be, is on operational efficiency, on energy reductions, on improving the well-being and the environment for occupants, because obviously people want, they want to get people back into space. They have to be focused on this stuff, and they're doing it very spottily, very patchily.
Again, thank you for a very nice segue. Faraz, one of the things that, again, I think is interesting about globalization, and Jonathan mentioned it, Lorena mentioned it, a couple of people in our last panel mentioned it, is the importance of standards and having a common expression for carbon, a common expression for ESG performance in investment in general. Building on the SDGs and actually crafting KPIs around them. Regulation, unfortunately, mostly happens, not even at a national level, but at a local level. What do you see in terms of trends for collaborative regulation, or regulation moving for, or do you see any trends about regulation becoming, I'm thinking, especially at the local level, more harmonized, so that, again, innovators who want to put forward global solutions can come up with something that is regulatorily compliant where their place of business is, but also adaptable on a more global level?
Thank you for this question, actually. Before I actually answer this, I was trying to explain around 7 years back to my 11-year-old daughter about ESG and impact. And she had recently seen the movie Titanic at that point of time. And she said, after I explained whatever I could, what she understood was, oh, so you basically mean the world is like Titanic as a ship, just getting into an iceberg, and the captain is sleeping without Leo and Kate. And at that point of time, I realized that creating a narrative, a simple narrative for the conversation that we are having on this panel and beyond, for the youth and the individual and community stakeholders, is absolutely critical, because these are the pressure points and the consumers that would actually make regulatory changes and institutional changes. And it's absolutely critical that I think making ESG conversations and impact conversations part of the basic primary and secondary curriculums at local and regional levels is absolutely critical. Moving to the institutional and systemic transformation and importance of regulation in that, we recently actually, in Pakistan, we launched this intervention called NSAGov. And the idea was very simple. So we got together the Stock Exchange of Pakistan, we got the SECPs, we got Unilever, top financial services institutions, cement industries, textile institutions. And the conversation was basically saying that the listed companies' share value, the price, is basically determined on sentiments and financial performance. And right now, the ESG disclosures are voluntary. What if we actually created a mandatory framework where the listed companies' share value would actually be determined on these 3 segments rather than 2? Everyone was on board, at least in theory. Now, the challenge is that In Pakistan, I'll give you the context of Pakistan. So Pakistan's largest export industry is textiles. And GSP plus status in Europe basically means that import of textiles would require certain measures and frameworks. And in the coming years, ESG would become a very, very important compliance reasoning for that export to continue and progress. Now, if the textile industry would not invest, now it's a very clear business case. If they wouldn't invest in these mechanisms, they would lose business. And for that, they're willing to actually make a lot of investments. So on institutional level, there's a very strong business case. The global expansion is not going to happen if ESG compliance is not going to be interwoven into the principles, policies, products across their value value systems, as well as the supply and distribution communities. And on regulatory level, the governments are actually learning that how much revenues they're losing and how contaminated their geographies are being made by these institutions who are not compliant. So the timing is absolutely critical, and it's apt for interventions like these on institutional and systemic level, and it's happening actually. In a country like Pakistan, where there are so many other problems and challenges, but these are the opportunities that I think in the next 3 years we'd see a lot of focus in.
I can just add on, of course, Mark Carney, another Canadian who was chair of the Bank of England, initiated the TCFD, the Task Force for Climate-Related Financial Disclosure, and again, it's a very realpolitik kind of observation that climate risk presents big risk for financial institutions, and therefore his point was big institutions, banks, and insurance companies need to understand and disclose these risks before they become systemic. Only a few weeks ago, the SEC in the United States has now made climate risk disclosure mandatory for US publicly listed companies. So this regulatory change is being driven by the real understanding of the economic, not moral and ethical, the economic impacts of how this is hitting us all. I think what's interesting is it's still moving too slow. I think we're all in agreement there. The PRI, the Principles for Responsible Investment, have something called a thesis and a set of work that they produce called the Inevitable Policy Response. And the IPR basically puts forward the case that the impacts of climate change are becoming more and more severe. The droughts, the storms, the flooding, and the economic impact is becoming so severe that if we do not address it in a sort of gradual way, at some point there will be a lashback of society. And when that happens, then the regulatory response will almost be too hard, and that can have big impact on asset classes like real estate, like the equity market and the bond market. So the IPR in their analysis says, under the Paris Agreement, every 5 years we take a stock take. And the stock take is we meet as all the countries of the world and we say, how are we doing? How are we doing to address? And under the IPR, they feel that around 2028 is the next major stock take. And based on what's happening, that is likely to be, we're not doing very well. And therefore, the response, the backlash, could be quite significant. So these are real systemic risks that we need to address. But like the earlier panel, every one of these problems is an opportunity. And in many cases, it's a financial opportunity, and therefore it drives innovation, particularly by young people, because they are going to have to face this. So, hopefully, I'm hopeful that human ingenuity is going to really help here.
Lorena?
Yes, well, actually, thinking about that, I think that I know that, especially in the construction, real estate, and all industry related with the built environment, is like a big elephant, But because they don't, it has been so difficult to move them to get more and more technological changes. Prop tech companies have been just starting to grade it, maybe in the last 10 years. So it's something so new. But you can find, for example, now new funding groups who have been going, they have been doing really great. So you have B Labs, for example, for the real estate, for prop tech. And even them nowadays, they have been trying to find companies who are being able to work on the climate, ESG, and all this kind of thing. Why? Because maybe the people who are building or something like that in the construction or in design, they are not being so aware, they are not feeling the pressure, but the insurance companies, they know really well what is happening. Yesterday, they were talking about in the Summit of Sustainability, and the Mayor of London said that in the next 10 years, we're just starting to map in what would happen here, but we know at least that 1/3 of the rails will be underwater. What does it mean? So I think that the people who are putting the money there, they know what is happening, That the point is how to map this kind of information more, how can I say, with more details, put this information for the general public, or if I can say it in that way, and react, But I've been here for around 10 years related to some kind of new technologies and something like that, and I know that when you notice that one problem and going to public with that kind of problem, first of all, you need to try to organize some kind of stuff inside in the government and in the company. So it's a big issue. Yeah. But if you notice what has been happening with the BlackRock, with the Church of England funding, they know what will happen, and they are taking their own measures nowadays.
They do know, but I would say there's three systemic level of risk here. Mm-hmm. The first one is in the financial sector. By the way, I think the financial sector has an absolutely key role as an engine of driving change in all of this, because at the end of the day, money's at the core of everything. Just yesterday, the BOE, the Bank of England, came out and with a latest stress test that said that British banks, UK banks alone, faced about £250 billion worth of debt, climate-related debt risk. Upcoming. I seriously believe that in the overall span of ESG and climate impact, what we're going to see is a financial crash of 2008-9, larger than that, yep, but slow motion. I mean, if ESG and ESG ratings now are sort of kind of CDOs of today, which takes you to the second strategic problem, which is ESG ratings, which underpin the $3 trillion market of responsible investing at the moment. Those ratings are wholly inadequate. They're based on subjective analysis, public data, and so on, and just are not going to get us there. And underneath that, which is probably the biggest problem of all, is that companies themselves, and I'd love to hear from anybody here who doesn't think this is true or doesn't think it's true for their company, don't actually know enough to be able to report their impact and their ESG performance. Yep. Because they don't collect all the data, they don't recognize it. So even I've talked to banks a lot, it's one of our big customer sectors. Even talking to banks saying, how do you do your own ESG reporting? And the answer is, well, we've got all these spreadsheets, and there's someone there, and there's all these email trails, and I put it all together, and there it is, there's my report. It's wholly inadequate.
We've only got 5 minutes left. I want to give each of you a chance to give the audience some very concrete and more tactical advice. Now, you all come from very, very diverse backgrounds, but I'm going to stick my neck out and make a guess that one problem you all share is that you would like to get better access to money. Now, that expresses itself differently. Universities are thinking about how to win grants, or pitch to their alumni, startups looking at venture firms, even within big enterprises, getting investment from their boards. And one of the critical success factors historically throughout history, if you want to get somebody to invest, is to have an in-person relationship, to meet them, impress them, get to know them, build a relationship. Even before COVID, that was starting to change, and investment decisions were being made increasingly on a purely virtual basis. That has accelerated, obviously, due to the pandemic. We've seen lots of investments now being made where the investor and the enterprise being invested in have never met in person. So you are all investment experts. What tactical advice can you give? How is it different pitching virtually to pitching in a traditional way? And what have you seen that works and doesn't work? How can you advise our audience? Mike, I'll start with you.
Yeah, I think more and more young entrepreneurs in the venture capital sector are marrying a passion to a profitable business model. And I think those two can be symbiotic, right? They're not opposed to each other. And I think the young entrepreneurs, particularly in tech, really have that outlook, which is wonderful. Venture capital is at a record level in terms of the amount of capital that's available. You have to, I think like the venture capitalist, and therefore your business model has to have a pathway to an exit event and a multiple exit for that VC, right? We know about the valley of death in venture capital investing, and how do you traverse that valley? That can be through government grant programs, seed VC, but if you want to get on board serious venture capital, you need to demonstrate a pathway to an exit event for that venture capital investor.
Thanks. Jonathan?
I'd say, first of all, purpose-based businesses are very en vogue at the moment. I've always believed in purpose-based businesses. I don't think most people really think that through what that truly means, and the VC industry isn't often incentivized to actually invest in that sort of thing. But I think it's really important, particularly with remote presentations, that you do have a very clear understanding, not only the financial exit, but also the purpose that you exist for. And I would go one stage further and say, when you get to the next level of questioning, understand, one point from the last panel, the difference between innovation and implementation, right? Innovation is great if you can't actually articulate how it will be implemented in the marketplace, both in terms of getting to the marketplace and helping the marketplace implement it. I think you're at a disadvantage. So I'd say that's important.
Okay. Faraz?
Well, 2, don't exaggerate. Please do not exaggerate. Second, there's the time for valuation-based enterprises, especially the tech ones, it's nearing its end. And if you don't have a plan for organic growth, where you are making money as you grow, then there is absolute something wrong with your business. There are a lot of tech demises that would actually happen in the next 2 to 3 years, and it has already happened. So it's going to be a hybrid conventional model where real business acumen, where you're actually generating revenues on daily basis based on whatever level of products and services you have. Focus on that. Valuation is going to be realistic now. It's not going to be hyper as it used to be in the previous years.
Great. And Lorena?
Go global. Sorry about that. Yeah, it's true. So nowadays, all the team are global. The challenge are global. I know that the legislation is different in every place, but you can pitch it globally as well. Yeah.
So, I'd like to close out. In neither of these panels have we had time for audience Q&A. I'm to some extent okay with that because I think both panels have added so much value. However, these people, or most of them anyway, will be here. So don't be shy. Use the breaks. If you have questions, if you want to explore any of these topics further, I guarantee none of these people would feel remotely remiss if you just approached them and asked them. So please do. Thanks very much.